Let's have a look at currencies for you now, and we are seeing a bit of downdraft for the local units, and this is coming, of course, on the back of some remarks made by RBA Governor John Edwards, saying that he himself would be more comfortable with an Australian dollar closer to 65 US cents, saying the A dollar appears to have stabilised. These remarks to the Wall Street Journal, incidentally, and that the A dollar is not reflecting commodity price falls. Neither is he confident of further Australian dollar falls, acknowledging that negative rates elsewhere will likely put upward pressure on the A dollar. The operative word there being upward, and that he does expect further postponement of Fed rate increases. Well, you look at the market-implied Fed policy curve today versus a week ago, and you kind of just get a chapter and verse rendition summary of what Dr. Edwards has just said. Let's talk to Andrew Barnett, live in Brisbane from LTG GoldRock. Andrew, welcome into the show this afternoon. These comments clearly have had a jaw-boning impact on the money markets and the cross rates this afternoon. What are your thoughts? Because even looking at the dollar-yen story reversing course alongside, just put it into context.
Well, at the moment, hi Carson, at the moment the Aussie dollar in the last week or so has really been a bit of a safety play, because we saw it pull back down to sort of 68.5 in January when we saw that big sell-off in the US, and then we've seen it rally back higher again. And I think a lot of the traditional currency traders around the world are sort of scratching their heads at the moment, wondering whether or not many of the correlations that we've been playing and trading for the last few years are going to continue to roll out that way this year, with all these central banks putting interest rates down and some of them even further into the negative. I think the RBA is probably a bit frustrated and worried about where the Aussie dollar is at the moment, therefore that little bit of jawboning today. But if we look at really the longer term impact of what happens through the rest of this year, we normally see in the last 6 or 7 years a very strong correlation for the Aussie dollar to fall between May and September. So I'm anticipating the Aussie dollar may sort of drift around 72 to 70 cents, and then perhaps from May through to September, the old sell in May and go away theory, we should see the Aussie dollar, in my view anyway, pull back down then, and that's when we're probably likely to see it around 65. But obviously, if all these central banks are cutting rates, there is a potential for it to become a safe haven currency with us paying 2% interest. But I still think they'll lower rates at some point between now and September, and interest rate swaps are certainly showing that as well. And
if you're going to Europe in early September, just to extend the analogy, but to maybe look at that pairing, what are you going to be eyeing? What are the prospects there? Are you looking at a more favourable environment, or are you saying that the A dollar will then, versus the euro, be likely where?
Well, I think both currencies have the potential to be lower. Where the Aussie dollar is against the euro, to be quite honest, I don't particularly focus and trade that currency pair, but I think the euro has the potential to be significantly lower if we see further weakening from the ECB with respect to interest rates and more stimulus, particularly against the yen. We saw Kuroda yesterday say that, hey, I didn't put rates down below zero to try and weaken the yen, which the market then took as an indication that they won't intervene. So I think the Aussie and the euro could potentially be lower between now and sort of around September. And at the moment, to me at least, gold seems like it's going to be a very good play this year with all of these central banks lowering rates, because people are going to want to put their money in cash, and we've seen gold up 20% already, and I think we might go higher.
So if you look at dollar yen a week ago, it was soaring 250 pips in 1 minute. Clearly intervention was in play. Are you saying the money markets are believing Kuroda now, whereas they clearly didn't then? I mean, what do you make of it?
Well, traditionally we would see, when they drop rates below zero, the yen to weaken and to continue to weaken for a number of months. The market said, no, we don't have that correlation any longer, we don't trust you. These same sort of impetuses these central banks are putting in place is not having the desired impact. And Kuroda's statement yesterday really put a nail in the coffin, in my view, that these central bankers, including him, have run out of genuine approaches to battle low inflation, etc. It's just not working for them. So I think they're going to have to come up with other plans, either buy up the stock market, which I think they were trying to do the other day when the market was up 7% in Japan. But I think they're running out of bullets, and they know that. So they're going to be having to come up with other approaches. But do I think the yen will continue to strengthen? Yes, I do. And I think that the intervention will be not coming anytime soon.
All right, because he's just said in the last hour, he said the BOJ will continue easing until it reaches 2%. But I guess you've got the vagary of a current account surplus, and when you've got that on your hands like the euro, we haven't really discussed that, but it's key, is it not, to continued support for those two currencies?
Well, I think, as I said, I mean, he's coming out wanting to get inflation to 2%. I personally, and I know I'm being tough when I say this, I think Japan's a basket case financially, and I think that they've been trying to get inflation to 2% since Abe became Prime Minister. They've done everything they possibly can. They've injected trillions of yen into the economy, and it's just not working. So it's getting to a point now where the global economy, in my opinion, is getting to a tipping point. And my biggest fear is that we're heading towards a global recession with central banks with not a lot of tools left in their toolbox that are going to be effective. And Japan, one of the biggest countries with the biggest debt in the world, they could become another tipping point for a global financial crisis. And I think that's a higher probability than happy days.
Okay, well, happy days to you for now. Make the most of the happy days, all right, Andrew? Talk to you soon. Andrew Barnett from LTG GoldRock. Taking a break, back after this.